Somewhere between your dental chair and your wallet, a Manhattan investment firm quietly took a cut, and you had no idea. Private equity firms now own thousands of dental offices, vet clinics, and plumbing companies across the country. This quiet ownership shift is what we'll call the silent landlord effect throughout this video. The silent landlord is invisible to you, but very visible on your bill. Private equity manages roughly $9 trillion in assets globally as of 2024. That figure exceeds the GDP of every nation on Earth, except the United States and China. A significant slice of that capital is now deployed in what the industry calls services roll-ups. Roll-ups are when one firm buys dozens of small businesses in the same industry. Target industries are boring on purpose, steady cash flow, low risk of tech disruption. Your dog needs a vet, whether the stock market is up or down 30%. Economists call this inelastic demand. Prices rise, but the quantity purchased barely changes. Predictable cash flows let PE firms borrow heavily to buy these businesses, which is where the magic happens. Borrowing to buy is called leverage, and it amplifies returns and risks dramatically. We'll crack open the leverage math in a few minutes because the numbers are genuinely surprising. Step 1. Buy a local plumbing company for roughly 5 times its annual earnings. Step 2. Acquire 20 more plumbing companies in the same region over 3 years. Step 3. The combined entity now sells for around 12 times earnings, called multiple expansion. That gap between 5 and 12 times earnings is where the bulk of the profit lies. No operational miracle required, just aggregation and financial engineering. Private equity raises money from limited partners, pension funds, endowments, and sovereign wealth funds. Your teacher's pension fund almost certainly has PE exposure. Indirectly, you are already inside this machine. CalPERS, California's giant public pension, targets around 13% of its portfolio in private equity. The minimum to invest directly is typically $1 to $5 million per fund. That velvet rope is the wall between most people and these returns, for now at least. When PE acquires a dental chain, prices at those offices tend to rise. Some studies cite figures around 10 to 15%. Research on physician practices has found PE ownership correlated with meaningful cost increases for patients. That is the silent landlord tax. You pay more so the fund can hit its return target. For a family spending $3,000 a year on dental, even a 10% rise means $300 extra annually. Compounded over a decade, that recurring extra cost adds up to several $1,000s in real terms. After a roll-up, fewer competitors remain in your zip code, so price pressure quietly disappears. Economists call this a local oligopoly, a handful of firms controlling a regional market. Economic research consistently shows that concentrated local markets carry higher prices than competitive ones. The silent landlord tax isn't a conspiracy. It's basic supply and demand working exactly as advertised. PE ownership also reshapes conditions for the people working inside those businesses. Academic studies on PE-owned nursing homes have found troubling correlations with staffing reductions and patient outcomes. Cutting labor costs is the fastest way to improve margins in a service business. Research suggests wages at PE-owned firms grow more slowly than at comparable independent firms. Over a decade-long career, slower wage growth can compound into a significant gap in lifetime earnings. Now let's open that padlocked door and look at the leverage math powering this whole machine. A PE firm buys a business for $100 using $30 of equity and $70 of debt. If the business grows to $120, the equity portion rises from $30 to $50. That is a 67% return on equity from only a 20% gain in business value. Flip it, if the business falls to $80, equity shrinks from 30 to just 10. That asymmetry is why PE funds produce both spectacular wins and very quiet disasters. PE funds often advertise net IRRs of 15 to 20% annually, which sounds extraordinary, but IRR is sensitive to the timing of cash flows and can be flattered by early distributions. A better yardstick is public market equivalent, or PME. How did PE actually perform versus the S&P 500? Academic research suggests top quartile PE has historically beaten the S&P by a few percentage points annually. Median PE funds, however, roughly match the S&P after fees, and fees are steep. The standard fee structure is 2% annual management fee plus 20% of profits. 2 and 20 sounds modest until you actually run the compounding math over a full fund life. On a $1 million investment earning 15% gross over 10 years, fees can consume a substantial share of gains. That fee load can be roughly equivalent to handing several years of net returns back to the manager. This is the silent landlord tax applied to investors themselves, not just to consumers at the dentist. There is one legitimate reason PE should earn more than public stocks: illiquidity. You lock capital away for 7 to 10 years, with essentially no ability to exit early. Finance theory holds that investors deserve extra return for accepting that illiquidity risk. Estimates of the illiquidity premium generally range from 1 to 3% per year above liquid equivalents. The real question is whether you actually pocket that premium after fees, and often the answer is barely. Here is a feature of PE that looks reassuring on paper, but deserves a closer look. Private assets are valued quarterly by the fund manager, not by a live competitive market. During 2022, public equities fell roughly 20%, while many PE funds reported far smaller declines. That smoothing reduces reported volatility, which flatters sharp ratios and correlation statistics. Lower reported volatility makes PE look like a diversifier, but the underlying risk has not actually changed. This is called stale pricing, a known structural limitation, not a scandal, but worth understanding. Diversification math relies on correlation. Assets that zig when others zag reduce overall portfolio risk. PE reports a correlation to public equities of around 0.5, which sounds like a great diversifier. But once you correct for stale pricing, researchers estimate true correlation is closer to 0.8 or higher. At that level, PE and public stocks tend to fall together in a real crisis. Diversification shrinks when you need it most. The silent landlord tax strikes again. The diversification benefit you thought you bought is partly illusory. Let's compare who wins and who loses from the roll-up model. On one side, PE general partners who collect 2 and 20 regardless of net investor outcome. The GP wins even in mediocre scenarios because management fees are paid on committed capital. The consumer pays the silent landlord tax whether the fund performs well or not. To be fair, PE roll-ups do sometimes deliver genuine value. This isn't always a story of pure extraction. Centralized billing, shared purchasing power, and professional management can legitimately reduce costs for the business. Some PE-owned vet chains have expanded into rural areas that previously had no local veterinarian. The evidence is genuinely mixed. Outcomes depend heavily on the specific fund, sector, and management team. This video is about understanding the mechanics, not rendering a final verdict on private equity. Regulators and fund managers are now pushing to open PE access to ordinary investors. Recent SEC reforms have expanded who qualifies as an accredited investor by professional expertise, not just net worth. Interval funds and tender offer funds now let retail investors access PE-style strategies with lower minimums. But lower minimums come with quarterly liquidity windows and redemption gates. Always read the fine print. The silent landlord tax on retail PE products is often higher fees and less favorable terms than institutional investors receive. Can't access PE directly. Public markets offer several ways to get partial exposure to similar economics. Publicly listed asset managers are one avenue. Their stocks let you own the fee engine itself. When you own the manager, you participate in management fees and carried interest, not just the fund returns. Business development companies, or BDCs, lend directly to the small businesses PE firms typically target. BDCs are required by law to distribute at least 90% of income, generating yields often in the 5 to 10% range. Small-cap value stocks overlap significantly with the types of businesses PE targets before it acquires them. Academic factor research shows small-cap value stocks have historically outperformed large caps over long periods. That premium exists partly because these stocks are illiquid and overlooked, the same traits PE deliberately exploits. Owning a small-cap value index fund gives you liquid exposure to similar underlying economics. You pay roughly 0.1% in annual fees versus around 2% for a PE fund. That fee difference compounds dramatically over 20 years. The gap in ending wealth can be substantial. Another public route: infrastructure REITs that own the physical assets underpinning everyday services. Car wash REITs, cell tower REITs, and storage REITs all share the same roll-up DNA as PE. REITs must distribute at least 90% of taxable income, giving investors steady cash flow. And you can sell REIT shares on any trading day. No 7-year lockup required. Let's honestly compare the risk profiles of PE versus its public alternatives. PE carries leverage risk, illiquidity risk, manager selection risk, and fee drag, all simultaneously. Manager selection is enormous. Top quartile PE beats the index. Bottom quartile can destroy wealth. Without access to top quartile managers, expected PE returns cluster around the median. Public small cap value carries volatility risk, but no illiquidity, no lockup, and minimal manager selection risk. Expected value is probability times outcome. Let's run the numbers on a hypothetical retail PE product. Assume a 30% chance of top quartile 15% net return and a 70% chance of 8%. Expected value: 0.3 times 15 plus 0.7 times 8 equals 10.1%. A low-cost small-cap value index has historically delivered comparable returns with full daily liquidity. The math says the risk-adjusted edge of retail PE over public alternatives is thin at best. Here is the part that should genuinely concern you. The silent landlord tax hits both sides of your ledger at once. As a consumer, you pay more for dental, vet, and plumbing services year after year. As an investor without PE access, you don't capture the returns that are funding those price increases. Combined, the silent landlord tax could represent a meaningful drag on your real annual wealth growth. Over 30 years, even a 1% annual drag compounds into a significantly smaller retirement nest egg. The FTC has begun scrutinizing PE roll-ups in healthcare for potential antitrust violations. Recent years have seen regulators challenge PE-backed healthcare mergers on local monopoly grounds. Some states now require PE disclosure before a firm can acquire physician practices. Regulatory risk is now a genuine tail risk for PE firms concentrated in healthcare roll-ups. This matters for listed PE firms too. Their earnings depend on successfully exiting these sectors. One underappreciated risk: roll-ups create heavy concentration in single sectors and geographies. If a regional economy contracts, a plumbing roll-up concentrated there can unravel quickly. Leverage amplifies the damage. A moderate revenue drop can translate into a severe equity loss. Spreading capital across many PE funds partially solves this, but requires far more capital to execute. PE return histories look impressive in backtests, but survivorship bias quietly inflates the numbers. Failed funds stop reporting. Only winners remain in the dataset used to calculate average returns. Correcting for survivorship bias meaningfully reduces average reported PE returns. This caveat is not unique to PE. All asset class backtests suffer from some degree of this problem. PE returns follow what is called a J-curve. Negative in the early years, positive later. In years 1 through 3, fees and management costs flow out before any exits occur. Returns only materialize in years 5 through 10, as the fund sells its portfolio companies. Need liquidity in year 4. You are stuck, or you sell at a steep secondary market discount. Secondary market discounts for PE stakes can reach 15 to 30% below net asset value. So what should a well-informed investor actually consider before taking on PE exposure? First, do you have genuine access to top quartile managers, or are you buying median performance at high fees? Second, can you genuinely afford to lock up this capital for 7 to 10 years without financial stress? Third, have you already maximized low-cost public market exposure before adding illiquid complexity? Fourth, does the fee structure actually leave you with a net return above a comparable public index? These 4 questions won't guarantee a good outcome, but they will help you avoid obvious mistakes. If you do access PE or PE-adjacent products, position sizing matters enormously. Most institutional investors cap private equity at around 10 to 15% of total portfolio. Beyond that level, illiquidity risk begins to dominate your overall portfolio risk budget. For most retail investors, a small allocation to PE-adjacent public products is a more manageable starting point. Zoom out. The roll-up trend is quietly reshaping the structure of the American small business economy. Private equity's share of business ownership has grown substantially over the past 4 decades. More of everyday commerce is now governed by return on equity targets rather than local ownership decisions. Whether that is good or bad depends on execution, and the evidence is still accumulating. What is certain is that understanding it helps you make better decisions as both a consumer and an investor. If this helped you understand private equity's role in everyday life, subscribe and hit the bell. We publish one rigorous explainer every week. Drop your questions in the comments and we'll tackle them in a future video. This video is for educational purposes only and does not constitute investment advice. Past performance of any asset class does not guarantee future results. Consult a qualified financial professional before making investment decisions.